Oh my, what has happened to Snap? All right, well, look at this here. Looky, looky. Snap has gone down 43% in one day. Oh, wow. Just got hammered. Amazing. So they reported earnings and people didn't like what they heard. So it looks like they sold it off. So let's see where they're at right now. From the very, very peak to where the last price was, down 85%. Oh my goodness, down 85%. Whew. Well, let's see what happened today. Why did this thing go down so much? So let's see. Downturn comes after Snap CEO, this is from Yahoo Finance, slashed his company's forecast, citing rising inflation and interest rates, supply chain constraints, and labor disruptions. Interesting, very, very interesting. And it kind of took out a lot of other companies like Facebook fell a decent amount too. And you can definitely see here it just got the crap kicked out of it. But yeah, let's take a look at the financials. So what I did is I just took their quarterly release that they just released, and what they have in there is they have the 3 months ending March 31st, and they have the comparison with a year ago quarter. So what I did is I'm going to go over here and I'm going to go to the income statement. We're just going to take a look here at the income statement. So we can see that the growth here. So they went from last year, they had 769 million to 1 billion. So the growth, 38% growth on the top line here. But you can see that overall, their total costs are somewhat higher than that. It went from 1 billion to 1.3 billion. And so they have pretty significant losses here. Now over here, we can do kind of a vertical. And so what we do is we represent all the expenses as a percentage of the revenue that came in. So you can see that they have the cost of revenue was 40%, but it was like lower on a percentage than it was a year ago. So it's about the same. Then research development, about the same. Then sales and marketing, about the same. I mean, it went up 22% as compared to 19%. And so this is as a percentage of sales, right? And then over here, your SG&A, it actually went down, but your total operating expenses are 125. Now, what's really interesting here now, okay, so admittedly, I'm not looking at the previous quarter. I'm looking at the year ago quarter. So don't have the whole thing here. Okay. This is kind of what I do. I just take a look at things, try to get some perspective on it. Maybe I will do a full financial on that and grab that data. But for right now, let's just look at this year over year quarterly. And you can see what's interesting is, they actually did better on expense wise, right? So their total cost and expenses is only 125% of their revenue versus it was 140% before. So because, obviously the expenses are more than your revenue, so you get a loss, and that's why they have a loss. So just looking, right? So here's a very, very interesting thing. Just looking at the income statement, it's not like some of those one of those other companies, one of the car companies, I think it was Carvana. I could be wrong, but one of them had where I had like the 5 years worth of data, and you could see how they were growing their margin slowly, but they were growing it. Their financials were improving in terms of how they were keeping their cost in line with their sales. So in this case, it's not like there's a sudden deterioration, at least looking quarterly year over year. There's not the sudden deterioration. It's not like, oh, their expenses went from, 140% to 500% or something. No, you're not seeing that. So it's kind of interesting. So they must have really been looking at what the guy said and must not have been liking that at all. Another thing to look at here, on the balance sheet, just kind of looking at the cash equivalent in marketable securities. So the cash position improved a little bit. Marketable securities grew. So overall, between those two, they got like 5 billion of cash equivalent kind of stuff on there. So that seems pretty reasonable. Let's go to the cash flow table. So as we've seen before, when you're looking at a cash flow, when you have a loss, you have to reconcile that loss. So basically, you have to fund it. Somehow you got to fund it. So net cash provided by operating was slightly positive. So where did they get cash? Let's see. I don't know where they got the cash from. I really don't know where they got the cash. They have a loss here, blah, blah, blah. Oh, okay. Stock-based compensation. See how that's a positive number because that's a non-cash expense. Okay, so that's kind of where that's coming in. So they're dishing out some stock there to people, all right, and they have some accounts receivable. So that's slightly positive at 127. And then by financing, net cash by financing, they spent another billion in cash here. So purchases of marketable securities is 1.3 billion, and they have maturities on securities of they netted 342 million. So net they were like spent another billion on purchases of some securities. What, I don't know. But where did they get the cash? Well, the big place they got the cash is from the financing activities. They got 1.4 billion, which are proceeds from issuance of convertible notes net of insurance cost. Okay, so what's going on here? If you look at this, what does that tell you? Look, they're issuing convertibles. So what they're doing is they basically sold a bunch of notes. They're going to be convertible at some price. You can go through their statement and figure out when they come due, what price they convert at, all that stuff. But what this all is potentially dilutive in the future, right? Because either way, a convertible note is a loan. Someone loans you money, but as part of that convertible, there's conditions where they can come in and get shares of the stock. So that has a potential dilutive effect. Now, what it looks like from looking through the financials is the reason they're doing purchasing securities because it looks like they're buying out. They have lots of convertibles and different kind of notes out there. And so it looks like they're like all the time they're buying back convertibles, buying back securities and issuing new ones. There's all kinds of stuff going on there to do the financing. So big picture is that's where they got it. They issued more notes to fund this loss. So once again, they're doing a lot of funding there. However, just noting from the balance sheet, they still got 5 billion in cash. They still got a big pile of cash there. So from that perspective, it doesn't really look that bad. So going back and looking at what was going on with their guidance from Barron's here, in a filing on Monday, Snap said it now expects year-over-year revenue growth for the second quarter will come in below the low end of the range of 20% to 25%. Okay, so this is the forecast is for 20 to 25% growth for the next quarter. The current growth was 38%. So that's definitely a drop in the revenue for sure. So trying to figure that out, the revenue drop, okay, yes, they had 38% here. They've probably been a higher growth company. So the growth is dropping off for sure. But I guess what is the market really concerned about? Well, it's very hard to say. But I mean, one of the problems is that they're not profitable, right? They haven't crossed the line yet where they've gotten their expenses under control so that they can actually turn a profit. And so the issue becomes just like we had seen, like the cars, where hey, every vehicle you sell, everything that you do, every service you provide, you're losing more money. So even if you crank that up, you lose more money. So I guess the issue with the forecast dropping, because everyone, in the market, they all just love the top line growth, right? That's what they're always looking for. But it can be a mistake. It's like, yes, you want top line growth, but you want it with improving profitability, or you want the growth when they have profitability. Here, they don't have the profitability. So it's just a huge problem. So in conclusion, Snap just, the stock is all that matters. The reality is like it's a train wreck trying to figure that out. But one thing I would say is that this company is already like, look, they're losing money and lots of money. So they're not really doing very well. So that's what I see there. And there's one other thing that I want to note for you here. Okay, remember that disaster that I think it was Teladoc had, that disaster with the goodwill write-off? Look at the goodwill line here. So I just want to point this out to you. This company has got 1.6 billion in goodwill on their books. So once again, what is goodwill? Goodwill is basically the excess amount that you paid for something. So at some point in time, and we could look through and try to figure out what they purchased, what they bought, but they bought a company and they paid 1.645 billion beyond the tangible assets and the intangible assets of the company. So it has to be recorded as goodwill. Now, just what happened with Teladoc. Remember, every year these companies have to go through and they have to make a decision. they have to follow GAAP accounting and they have to make some kind of decision about these. And they have to decide, well, is that value still appropriate or does it have to be written down? Now, this is the start of the year. I assume they did it at the end of last year, so we're probably okay. It's just something to kind of keep in mind. It's something where, you can find yourself getting surprised. And so if you were looking at companies, having a bunch of goodwill on there, that's a significant amount of your cash, significant amount of your earnings. So for example, let's look, we have 1.6 billion goodwill. Income statement, 1 billion. So you have 1.6 times goodwill than your revenue for this quarter. So now this would have, I think it would be written off on a yearly basis, check on accountant, but like if they had to write off $1 billion of that, it would wipe out the entire revenue, right? And it would be a huge loss. So that's just something to kind of keep in mind, the goodwill as a percentage of your revenue, because if it does get to be large, and if the company has deterioration, why do I bring that up? Well, the growth is deteriorating. They're losing money. And with the growth deteriorating, these losses are going to be much more difficult to sustain. All right. Well, I think that's it for this one. Talk to you later. Bye.